You are listening to Keystone Stock Talk Show, episode 215.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back with you again this week. We truly have a packed show. We will kick off. Aaron's going to discuss investing in gold royalty stocks and examining the fundamentals of 6 of the more well-known and actually profitable gold royalty stocks in North America. In the discussion, we include Franco-Nevada, FNV on the TSX, Wheaton Precious Metals, WPM on the TSX, Royal Gold, RGLD on the NASDAQ, Cisco Gold Royalties, OR on the TSX, Triple Flag Precious Metals, TFPM on the TSX, and Sandstorm Gold, SSL on the TSX. I will take a listener compliment on Hammond Power, HPS.A on the TSX, and answer their question on AirBoss of America Corp, symbol BOS on the TSX. That's a lot of symbols. The company develops, manufactures, and sells high-quality proprietary rubber-based products such as rubber compounds, rubber footwear, handwear, gas masks, anti-vibration automotive components, and industrial products. This pandemic star, which spiked to $46 in December of 2021 on the backs of personal protective equipment or PPE equipment contract wins from the U.S. government, now trades in the $7 range as these windfall contracts dwindled down. I will answer whether we finally see value or if the slide can continue. Following the new PGA Tour merger with the Saudi-run public investment fund, which owns LIV Golf, Brennan, and I stress him alone, thought it would be interesting to look at some golf-specific stocks. In the crosshairs this week are Acushnet Holdings Corp, symbol Golf, on the New York Stock Exchange, which owns the Titleist brand, known worldwide for their balls. The second company, Topgolf Callaway brand Corp, symbol MODG on the New York Stock Exchange, owns the Callaway golf brand and acquired the popular Topgolf driving ranges for around $2 billion in 2020. Brennan lets you know if he can marry his passion for the sport with a great investment opportunity. Finally, Brett will handle our star and dog segment. Our dog of the week is Tenet Financial Group, symbol PKK, on the Canadian Security Exchange. Tenet is a fintech technology service provider which operates in both Canada and China. The stock has fallen 66% to 13 cents over the past month. Brett will let you know if this former high-flying microcap and what has hit this former high-flying microcap. Our star of the week is Adobe, symbol ADBE on the NASDAQ. Adobe is one of the largest and most diversified software companies in the world. The stock has risen 40% in the last month alone. Is it AI, better financials, or what else is driving the stock? Brett will fill you in. All right, let's get to the show. My co-host, Aaron, Brett, and Brennan, the Killer Bees. How you guys doing? You have a good weekend?
Sure did. Yeah.
You know, I just realized something. All 4 of us are wearing glasses today.
Amazing.
Wow. That is true.
Yeah.
It may have happened before, but it's brilliant to point out.
I'm sure at some point.
Well, the podcast listeners really wanted to know if we're all glass-faced tonight. Hey, 4 eyes. All right. Anyways.
Yeah, I guess this is news too for my life. I became an uncle ×2 over the weekend. So my sister had
twins.
A baby boy. So she's now had a baby boy named Maxton. So little hipsterish, I guess you could say. But yeah. So now I have a niece and a nephew.
Apparently, you said it's an Irish name.
Thank you.
Is it an Irish name?
apparently it's an Irish name. And I was just on the phone with my sister.
So sorry, what's the name again?
Maxton. So it's like Max and then Tyn.
Maxton.
Yeah, Maxton.
Maxton.
Yeah.
Okay.
Yeah.
Yeah.
Cool. Well, congratulations mainly to your sister.
That's like an authentic Irish name.
Supposedly. This is what I'm told. Because at first when I heard the name...
You can neither confirm nor deny.
You thought it was made up is what you're saying at first, but it's not.
Yeah, exactly.
We know it's not.
So it's Maxton.
Maxton. Yep. Maxton.
Okay. That's not bad. At first I thought you said Max Tam.
No. Sorry.
Like,
it's a hyphenated Max and Tim. They were twins.
It's not hyphenated.
Yeah.
No.
Yeah.
Oh, good. I had, it wasn't actually her birthday, but it was my daughter's birthday, like school birthday, where she invited like 14 kids from her class, and we went bowling. And it was, you know, you can imagine 7, 8, 9-year-olds, 14 of them bowling. It was a bit of a crap show, but it was super fun. It was good. Lots of adventures, lots of balls getting in other alleys somehow. But, you know, that's what tends to happen at these things. They had a good time. I was surprised there was about... There's 5 or 6 there that have never even golfed, or it's not golf, sorry, bowled.
10 pin or
no? We went 5. Yeah. I mean, it's 10 pins. I prefer 10 pin. Brennan likes 5.
I was saying I like 5 better. Well, but, you know, you can just really get the the whip on him, you know. But
my daughter, who just will be turning 8, said these balls are too small for me. Like for Brennan. He's all into the 5 pin, right? That's good.
Yeah.
It's good. It's good. That's funny. No, we had a good time, and it was a Harry Potter theme, so we all wore we're wearing glasses today, but we all wore. Everybody there had the round glasses on, the Harry Potter glasses, the iconic, and the scars on our forehead. So it was a good time. We also this past week just released a special report on our U.S. clients. We did some research on roughly 3,000 U.S. stocks with a market cap of under $2 billion, making 2 new recommendations, as well as about 6 or 7 high conviction monitor stocks, as we are looking to potentially add these companies to our coverage over the next year. I think it's a great report, about 145 pages in that range. There's 20 to 30 total reports, I believe, in there on individual stocks that we're monitoring, and those high conviction monitors, as well as those 2 recommendations. So any of our clients out there, check your inbox. It came out this morning, I believe. And maybe that's yesterday if we tape this in advance, but it just came out. Check your inbox. There's a couple new recommendations there and new companies to discuss in our Wednesday chat upcoming this week. It'll be great to introduce those new companies to our clients and start buying and look what they can do over the next 3 to 5 years in their portfolios. Any comments on that? You have fun researching for this, guys?
Yeah, sure did.
Yeah, well, it's always an enlightening experience, right? Because you're going through thousands of companies, literally, which requires learning about the different industries, kind of understanding where the valuations fit in each industry, like what industries, are relatively more expensive or less expensive to the market, and then figuring out why. So it's probably one of the more fascinating parts of being a research analyst is when you look at so many companies at once and you just really have to dig into it. But no, I felt we found some very interesting companies that came out of it, very unique businesses.
Yeah, without a doubt. All across segments,
a couple
right?
That might be familiar, but many that I'm sure, not many people have heard of before.
Yeah, some great businesses. Yeah.
A theme that I kind of found as we went through a lot of the companies and then really dug in was, a lot of companies are kind of experiencing gross margin compression right now. At least the companies that I was researching, and a lot of management teams are anticipating, margins to expand. Like there was one food distribution company that I was looking at, another manufacturing company as well. So obviously, input costs may be a factor there, but that is one kind of thing that I saw as well. We had some interesting management interviews as well. Some good, some bad, to say.
We probably reached out and interviewed 15 to 20 management teams, some in person at conferences that we were just at, some over the phone, some, web. or video conferencing, and interesting interviews that went through, some that may lead to recommendations down the road. Some confirm we don't want to have anything to do with them. Some confirm that, yeah, this is the type of company we wanted to invest in. So, it's always interesting to talk to all those management teams over the past couple months and come out with those recommendations, really unique companies that we have in there, which is great. Some of the, real cash rich businesses that are generating cash flow. And, if there is a downturn, they can survive it and thrive out on the other side. So those are the things we're looking for. Not necessarily always they have to have a net cash position, but, one of the companies we recommend had roughly what, Aaron, like $500 million in cash sitting in the bank. Like it's in that range, and,
significant portion of its market
per share or something
like
that,
yeah,
I think, on a per share basis.
Yeah, and the company trades like in the $30 range. So it's a significant portion of its entire market cap sitting there in cash. And, has the ability to deploy that to juice future growth. But, if they make an acquisition, it's going to come out of cash. It's not going to come out of the company raising capital, issuing more shares. So, it's great to see.
And then they can use that as well to buy back.
There may be a dividend, who knows? All of those things are in play when you have a balance sheet like that. So, yeah.
And then, go on.
Go.
Or I was just going to say as well, like the top tier monitor list, we do have, a few names which we would like to build a position. We're being patient. But yeah, there's
a couple names on there that we're almost certain we're going to add to coverage over the next year. We're looking for an opportune time. Some of them have tough comparables over the previous year, but we see growth like 3 to 5 years forward. So if we can get the price that we want, not going to try to get too cute, but if we can get the price that we want over the next year, these are companies that we want to be involved in. So yeah, it was a good report. A lot of research goes into it, and that also helps us now adding companies going forward to that U.S. portfolio. So exciting to see, and we'll continue to do that going forward. And again, we're right on our next report. Right now we're starting an electrification report. So we're looking at, we've whittled it down to about 400 companies that are loosely in that sector. We think it's a long-term 10-year plus theme, the electrification of the world. We're putting that report together now and going through those companies, the similar process. Won't be 3,000 companies like the last report, but if we can whittle it down from 400 to, about 5 or 10 individual companies that we like right now in that segment, just showing you what to avoid and what to potentially invest in that segment, as we see EVs being a huge theme going forward. But where can you play this industry over the long term? Like we've already had one tremendous success in that, and that kind of, if we can just move into the show, it dovetails into a question that we got over the past couple of weeks. This is from Deidre. She said, I would like your take on AirBoss America. She also says on Algoma Steel. I can address Algoma next week. I'll talk about AirBoss of America Corp. She went on to say, I want to let you know that I purchased 200 shares of Hammond Power on the TSX back on February 10th. So I just wanted to thank Keystone. I believe it will be another Boyd. Too high, she said, for me to buy at this price, Boyd. We still like Boyd long-term, although now it's trading at all-time highs once again. So she said, thank you for your upcoming advice and much appreciated. Now, just to let the listeners know on Hammond Power, it's been a tremendous success story in our Canadian growth stock research. What does Hammond Power do? They enable electrification through its broad range of dry type transformers, power quality products, and related magnetics. It's a basic, boring business with huge growth that traded at very low valuations, even just to start this year. If you look year to date this year, that stock is up 138%. If you go back to just the start of 2022, it's up over 435%. It's really, I highlight it, and why I'm continuing to talk about it is it's a great example of our research, because there has been no other research firm in Canada or the US that has covered this stock over the past decade. Back even further, if you go back to when we originally covered it right at the turn of the century, essentially. Hammond Power is literally the best performing revenue producing stock on the Toronto Stock Exchange this year and over the past year. Despite this, however, not one of the big banks, the brokerages, boutique investment houses even bothered to cover it. Again, despite this tremendous growth in the business, not just the stock, in the underlying business here in terms of cash flow and revenue, and it playing into a great investment theme. You had no coverage. Well, you should ask why. Now, I will give you my take on it. I'll let the guys talk about it as well, but I'll let you on a little secret here. Banks make their money, and boutique brokerage houses make their money from conducting financings for public companies. Hammond Power has not needed capital, and the street ignores it. So if you're a client of the big banks, you would not have known about this company. It's not going to find its way into your portfolio. It's up 4,500+% over the last 2 decades, but you would never see it on BNN or in your portfolio, of course, as I like to say, unless you used our research. So to answer the question, Deidre, is it the next Boyd? Well, perhaps. It's still, it's over the last 2 decades, it's halfway there, basically. But Boyd is up 10,000, 11,000% over the last about 12, 15 years. So to get there, it still has a long way to go. There's a little more cyclicality in its industry, but if you look at, in terms of Hammond Power, what management is forecasting in terms of revenues 3 to 4 years out, $750 million, and perhaps getting to the $1 billion revenue mark by the end of this decade. If they can do that, it could be well on its way to being the next Boyd. There will be more volatility in that business, as there is. It follows the general and economic trends, but there is this wind at the back in the electrification, the grid in the US wearing down, and you're having to replace transformers. So it has wind at its back from that perspective. We'll continue to follow it and continue to have recommended Hammond Power for years and years now. And now it's starting to get attention. But your real gains were when it had great fundamentals, good growth path ahead of it, and traded at those reasonable prices. So that's that. Now I can get on to AirBoss of America Corp. I'll answer the question here. Symbol BOS on the TSX, trades at $7.13, $193 million market cap. What does AirBoss do? They develop, manufacture, and sell high-quality proprietary rubber-based products such as rubber compounds, rubber footwear, handwear, gas masks, anti-vibration, automotive components, and other industrial products, offering enhanced performance and productivity to the transportation, military, and industrial markets. The company also sold what is called PPE, or personal protective equipment, to the U.S. government during the pandemic, and continues to sell that equipment. Essentially, this is specialized clothing or equipment worn by an employee for the protection against infectious materials. Now, there was a surge in sales and profitability during the pandemic. AirBoss was the beneficiary of pandemic-era non-competitive U.S. government contracts for its PPE equipment. The contracts are now likely somewhat one-time in nature, at least the metrics on those contracts are, and future contracts will be more competitive if signed, meaning they will not likely show the same profit margins during the pandemic, when it was just a question of getting the product and there wasn't a question of what it cost, really. These contracts led to a massive spike in earnings. EPS in 2019, for example, was 55 cents per share. 2020, it was $1.49, so almost 3 times higher. Then in 2021, it was $1.54. But as the contracts kind of started to roll down, earnings cratered to a loss in 2022 of $1.26. So that is why you've seen the share price go from $46 down to $7. What did we see in Q1 of this year? Well, revenues decreased 19% to $117 million. Adjusted EBITDA was down 47.6% to 10.3. And EPS in the quarter was just 5 cents as opposed to 35 cents in the same quarter last year. Let's quickly look at the balance sheet. Cash of $16.6 million. Debt, net debt here is about $122.35 million. So the trailing net debt to trailing 12-month EBITDA is in the range of 2.99, basically 3, as at March 2023. So this is okay, given it does have EBITDA. It is profitable, but not spectacular in a rising rate environment. And particularly the size of the company, these debt levels are a little high for our blood. Let's look at the valuations. Current PE based on 2023 expected EPS of about 23. Expected to see a jump in earnings in 2024. This is what the analysts are expecting. I think it might be overly optimistic if the macro environment continues to see some headwinds. So our take, it was somewhat encouraging to see AirBoss's profitability in the defense segment rebound in Q1 after 2 consecutive quarters of lackluster margins. The division reported adjusted EBITDA, which was positive of $4.1 million compared to a loss of $1.5 million and $2.4 million in Q4 and Q3 of 2022. However, like I said, debt is high for a business of AirBoss's size and is cutting into profitability. With little revenue growth expected in 2023 and into 2024 at present, outside of new kind of unexpected contracts in its defense segment, the path to the higher share price appears to just be margin improvement. While this is a possibility, it could drive the share price higher. We like to pair profit growth with revenue growth, as in tandem, the two are a more sustainable path to driving consistent profit over the long term. And this will drive the share price, not just to a rebound, but a sustainable uptick. At this point, we just monitor AirBoss as the growth does not match our criteria. Thank you.
Good job. I mean, there's a lot of businesses that had a big boom during the pandemic, but it was really just serving like a temporary market condition.
So many now that we're seeing, right? Like it's,
and in a lot of cases, once you get away from those year-over-year comparables, you start to just get back to the base core business. But
there may be an opportunity there at some point because some of them get really punished down. There may be an opportunity. In this case, I would still monitor. If there was a better balance sheet here, it might be intriguing. But at this point, that's not the case. So, I think there's better situations that could be beaten down that got a one-time bump. We took advantage of that with a company called Biomed, which procured vents during the pandemic. Its share price got unjustly beaten down because they didn't have the same one-time sales in a couple of their quarters, and we were able to take advantage of it when it's pulled back. And since then it's up 130, 140%. Good core business, had a good balance sheet. That was the other thing that Biomed had. And that's why we've been able to profit from that over the last year. All right, Aaron, I kind of cut you off. You were going to go into you were going to start the show, but it kind of dovetailed into what we were talking about there with the electrification. But you want to talk about examining the fundamentals really of 6 of the more well-known and actually profitable gold royalty stocks. And that came from a listener question as well, I believe.
Yeah, it was a client question, actually. The person was really just interested in what kind of ideas we had to invest in gold specifically. And I thought it was a good enough question that I wanted to really kind of dive deep into it. And we do have some recommendations that we've discussed before that are indirectly operating within the gold mining space, say as a processor or a miller. But generally speaking, we don't really love to invest in mining companies. And there's a couple of reasons for that. So one of those reasons is just that they're obviously so commodity price sensitive, right? Like everything about the business is really going to revolve around the commodity price. If the commodity price goes up, they have an opportunity to produce better revenue and cash flow. If the commodity price goes down, it doesn't matter what your asset looks like. You're likely going to produce a lot less cash flow or even go quickly to negative cash flow. Now, obviously, any company has some susceptibility to macroeconomic conditions. But commodity prices like gold and metals, oil and gas are particularly volatile. They fluctuate quite widely, even throughout a single business cycle. But there's also another reason as well, and that's that mining companies themselves aren't necessarily great proxies to the price of the underlying commodity. So we'll just take an example with the price of gold, right? So this is a 10-year chart on just the price of gold, the commodity price. And, there's areas of flatness, but, generally fairly decent upswing from, around $1,300 per ounce 10 years ago to just under 2,000 per ounce right now. Now, I'm going to compare this to the price of the largest gold mining company in the world, which is Barrick Gold, ABX. And the price looks completely different. So you would think that, being a large diversified mining company, that would, result in you being a good proxy to the price of gold, or perhaps you'd be more volatile than the price of gold, but you would go up more when the gold price goes up, maybe down more. But you really see very little resemblance between these two charts. Barrick is extremely volatile, extremely fluctuative, and it doesn't look from the chart, just looking at it, like it's really produced much of a return at all over the past 10 years. Now, if we break these numbers down and compare them, the 1 year, the 3 year, the 10-year return, gold, the price of gold is up about 7% over the last year compared to Barrick's share price, which is down 13%. Gold is up about 10% over 3 years. That's not per year. That's not compound annual. That's just 10% over 3 years compared to Barrick, which is down 40% over 3 years. And then if you look at the 10-year return, gold is up about 56% and Barrick is up about 25%. Now, these returns don't include dividends, and Barrick does pay a small yield. So when you add the yield in, certainly for the 10-year return, that's going to explain a lot of the differential here. But another thing that we also have to consider is that Barrick's share price has been so volatile over the last decade that, you know, if we were to just basically start our calculation even a couple of weeks before the date, which would be June of 2013, the 10-year return, if we were to just, you know, start that calculation or adjust it out a month back, you would get a completely different return. It just so happens that we're calculating the return based off of a point in time when Barrick's share price had come down significantly. So, you know, it's really like just pinpointing that 10-year return on Barrick. I mean, a 9-year return, a 10.5-year return is going to look completely different. So much more volatility in the gold miner's price. And then if you look at this as well on a risk-adjusted basis, so return as you know, also factoring in the volatility of prices, you can see that gold on a risk-adjusted basis has produced far better performance than Barrick Gold. And I'm using Barrick here as a proxy for mining companies. You know, some mining companies, I'm sure, perform better, others worse. But it just goes to show that, you know, investing in a mining company, it brings all of the risks of the underlying commodity, but it also brings a lot of other risks. But there is another option that I wanted to explore for our client here for investing in a stock that has exposure to the gold price, and that is looking at gold royalty stocks and gold streaming stocks. Again, this is not a space that we're incredibly active in, but I felt it was worth a bit of a dive to see what was out there and what the opportunities were. So a royalty or a streaming company, it's essentially like a specialized finance company. And what they do is they provide upfront capital to the mining companies in exchange for a royalty on their production, or just the right to purchase mined gold or whatever other metal they're investing in at a fixed price. So if the price of gold increases, then they're generating a margin off of that. So royalty stocks, one of the reasons why I like that structure a little bit better is because they have far less operating risk. They are less capital intensive in terms of, you know, what is required to build a mine. Mining is an extremely complex endeavor. I really feel that in many ways you have to be a bit of a specialist to fully understand what's happening if you want to have a good conversation with the management team of a mining company. So royalty stocks just tend to have a much cleaner structure, higher margins, and they generally have the ability to produce more stable cash flow. Now, the flip side to that is that royalty stocks generally trade at much more expensive valuations relative to mining stocks. And this reflects that cleaner, more easy to understand operating structure and those higher margins. Now, with mining companies, you can often find, especially small cap mining companies, trading at very low multiples of maybe only 2 or 3 times cash flow, sometimes even less. A lot of times, though, this also factors in the risk that it's a very undiversified company. There may be issues with reserve life or uncertainties in that area. But what I wanted to do is I wanted to look at specifically at gold, royalty, and streaming stocks, see what's available, and just get a bird's eye view or a high level view of the fundamentals. So I did my searching, and what I identified 6 gold royalty companies that are trading in North American markets. Now there are a couple other companies that do list themselves as a gold royalty or streaming company, they didn't make this list. The reason why they didn't make this list is because they would not have been profitable or cash flow positive, or perhaps producing very marginal cash flow. But these are the only 6 companies in the royalty space which are meaningfully profitable, producing meaningful levels of cash flow. That's Franco-Nevada, Wheaton Precious Metals, Royal Gold, Osisko, Triple Flag Precious Metals, and Sandstorm. Now, if somebody thinks that I've made a mistake here, that I'm missing something, then by all means, put the name of the company in the comments. I'll take a look at it, and I'll follow up in the comments, or maybe even on the next show, and just give a quick analysis of that company. But from what I can see, anything that was called a royalty company outside of these 6 didn't produce the profitability that I really felt they were worth at analysis. So all 6 of these companies, with the exception of one, so 5 of these companies trade both on the Canadian market and the US exchange. Royal Gold is the only one that just trades on the US exchange. It trades on the NASDAQ. So I have the companies here in order of market cap. Franco-Nevada is the largest company by market cap, about $28 billion, followed by Wheaton Precious Metals, $20 billion, all the way down to $8 billion for Royal Gold. And then $2.9 billion is the market size of Osisko and Triple Flag. And Sandstorm is the smallest of the group with a market capitalization of $1.6 million. And then in terms of yields, they all pay a yield. None of these yields are particularly impressive. They range from 0.9% for Franco-Nevada up to 1.4% for Triple Flag. All these companies are basically in that range of about 1%. So there are different ways that we can analyze the performance of these companies. What I'm going to focus on here is I'm going to focus on growth in operating cash flow per share. I'm going to look at growth in the recent quarter, last year, and then compound growth over a 3-year period. So, for a lot of these companies, it's a little bit over the map. So Franco-Nevada down, cash flow per share was down about 9.3% in the quarter. A little better than flat for the year, but very impressive 3-year growth. It's the opposite case for Osisko, which had a very strong quarter of cash flow per share growth, but then down for the year. And then lackluster for the 3-year. Wheaton Precious Metals down 36% for the quarter, down 12% for the year, compound growth of 13% over 3 years. Royal Gold, a little more consistent here, about 7.5% growth in the quarter, negative 9.7% for the year, but compound growth of 18% over 3 years. Triple Flag, again, more stability here, up about 20% for the quarter, down 6.4% for the year, and compound growth is 6.4%. Now, the company that has the most consistent track record of growth over all these periods, that would be the smallest company, that's Sandstorm Gold. 14% growth in cash flow per share for the quarter, 10%, 10.6% for the year, and then compound growth of 3% or 13% over a 3-year period. Now, I'd mentioned before that royalty companies tend to trade at higher valuations. We can see that by looking at the price to operating cash flow for these companies. So this is operating cash flow over the last 12 months. The highest in the group would be Wheaton Precious Metals. So they traded about 31 times cash flow. Franco-Nevada, Osisko, both right around that 30 times range. Triple Flag trading at 22 times cash flow. Royal Gold, a little bit better at 19. And then the cheapest in the group is Sandstorm Gold, which again also happens to have the most consistent financial performance in the group as well. So that's 13 times cash flow. So that really is not, based on my experience of looking at royalty stocks in the past, that's actually not a bad valuation to cash flow, especially considering that the company has had pretty consistent growth. So again, this is not an in-depth analysis. This is a bird's eye view of the entire space, so that we can essentially identify some areas that we want to investigate further. Now, if I were to just look at the growth in cash flow and the valuation, then the standout to me would definitely be Sandstorm Gold. As I said, consistent growth over a period of time and what I would consider to be, fairly attractive valuation for a royalty company. However, when we look at the balance sheet, we need to factor some other things in, like debt, like how are these companies financing themselves? So Franco-Nevada, Wheaton, both have net cash balances, but Royal Gold, Cisco, and Triple Flag, even though they have net debt on their balance sheet, it's a very manageable level of net debt. Net debt to cash flow multiples all below 1x, basically almost zero for a Cisco. So these are very stable balance sheets, good solid financial positions. Sandstorm, on the other hand, in spite of it being the smallest company in the group, has the highest amount of net debt, 470 million, and a net debt to cash flow multiple of 3.8x. So that's a pretty heavy multiple. I mean, especially when you're comparing it to the group. And then as well, when you're considering the fact that this is a cyclical industry as well. There is some exposure to the price of gold here. So that really explains perhaps the valuation discount that we're seeing relative to the other companies, is that Sandstorm is a company with greater leverage. Now, I still think that the valuation, the growth, the future potential of Sandstorm is worth some further investigation if we wanted to dig deeper. But if I had to pick one of these companies right now that's just stood out with decent metrics across the board, it would probably be Royal Gold, which is perhaps not coincidentally the only company that does not trade on a Canadian exchange. And I pull that out just because, it does have that good solid balance sheet. It does have, decent growth in the last quarter, decent growth over 3 years, and then valuation of 19x cash flow doesn't seem like it's too stretched to me. From a market size perspective, it's about right in the middle of the group. I know from looking at their company presentation, they think they're big enough to take advantage of some of the larger opportunities out there to get royalty streams, but they're also small enough to put up decent amounts of growth. So this is by no means a recommendation, but it's certainly an interesting name. I would look further into Royal. I'd look further into Sandstorm, and probably Triple Flag precious metals as well.
Yeah, it's interesting. We actually included Sandstorm just as a monitor report in our 2022 cash rich report, because it's interesting to see at that time they did actually have a cash rich balance sheet, or I mean it wasn't a huge cash rich position or anything, but they did have net cash. But since then, obviously, they've dipped into that net debt, and it's cool too, Aaron, just that you did bring up the multiples, because even in my report, or in the report that I wrote on Sandstorm, I ended up including the comparables, essentially, including exactly the companies that you brought up, Franco-Nevada, Wheaton Precious Metal, Royal Gold, Cisco, Triple Flag, and really all of the valuations have stayed relatively the same. But at that time, again, Sandstorm was trading with it was a forward price to FFO, or funds from operation, of about 13 times. So, a year ago, we're still seeing kind of that discount on the company. And again, it is quite small, but yeah, no, good job. I thought that.
And that was a forward.
That was
FFO?
a forward. This was. I
wonder if they hit that FFO estimate. That's the question.
We should.
Right?
Yeah, I should take a look. But yeah, I guess I should take a look and see. If
not that you have to pull it up right now, but I wonder if that hit, and if I mean, it depends on where the price of gold is, and yeah. Let's move on. I mean, was there any more comments, Aaron? It was a good summary. I think that did more than enough to answer the client's question, essentially, on gold royalties. I mean, I think, like you summarized the performance of Barrick. I do think if you want to play this segment long term, a good high quality royalty company is a better way to go often than one junior miner or even one senior mid-tier miner that has that one or two mine exposure. I think that this is a great way to play it. Franco-Nevada over the long term has been a good example of that. All right, now let's look at, Brennan, you wanted to look at the golf segment. You wanted to talk quickly about the Saudi LIV Golf purchase or merger with the PGA, and then you want to talk about those two golf-related companies.
There's been a lot of news recently with the PGA Tour merging with the Saudi-Ran Public Investment Fund, which owns LIV Golf. And I thought that it would be, just kind of interesting to look at some golf-specific stocks, as there has been a lot of attention on the sport lately, and just look exactly on what drama has actually played out here. So this is essentially how things played out. I'm going to give you a quick quick little rundown here. So in 2022, Greg Norman, a legendary golfer, launched the Saudi-funded LIV Golf League and poached some of the PGA Tour's biggest stars with guaranteed contracts worth as much as $200 million. And just to get the league going, the Saudi Public Investment Fund invested more than $2 billion in 2022. Now, this led PGA Commissioner Jay Monahan to suspend multiple players for competing in LIV golf tournaments, and led LIV players to file an antitrust lawsuit against the PGA Tour, alleging it was using its monopoly to squash competition. And then this led the PGA Tour to countersue, accusing LIV Golf of interfering with its player contracts. Well, a Wall Street investment banker who is on the PGA's board, and his name is James Dunn III, ended up reaching out directly to Yasir Al-Rumayyan, the governor of the Sovereign Wealth Fund. And after months of positive discussions, they ended up drafting a deal. So according to the agreement, Jay Monahan, the commissioner of the PGA Tour, will oversee the PGA Tour and the LIV Golf League. And the PGA Tour will now control a new, yet-to-be-named for-profit entity, which combines Saudi's public investment funds, golf-related commercial businesses, with the commercial business and rights of the PGA Tour. So it's really going to be interesting to see how things play out here, especially since the PGA Tour has always been a non-profit organization. And now both the PGA Tour and the Saudi Public Investment Fund are coming together to fund a for-profit entity. But Brett sent me this actually last night, just this past Monday. So right now, yesterday, the U.S. Senate ended up opening an investigation into the PGA Tour LIV deal. So it will be interesting to see if anything comes from their investigation. So that's essentially the drama that's played out here in golf. And sticking on the theme of golf, I thought that it would be interesting to compare two golf-related stocks, which both sell clubs, bags, golf balls, basically everything and more that a golfer could need. So the first company that I'm going to look at here is Acushnet Holdings Corp, or Golf, GOLF, on the New York Stock Exchange, which owns the Titleist golf brand, which is a premium company, as many of their products, especially their golf balls, come at a premium. I thought it was kind of cool because my dad actually gave me an old Acushnet golf ball from the 70s. And you can see they have changed it to Titleist, of course. But anyways, that's just a cool little thing that I have. I've got a golf ball, an Acushnet golf ball from the 70s, which obviously they aren't putting Acushnet on golf balls anymore. Now, the other company that I'm going to be looking at is Topgolf Callaway Brands, or MODG, on the New York Stock Exchange, which again owns the Callaway golf brand and acquired the popular Topgolf driving ranges for about $2 billion in 2020. So let's compare the two. So right now, Acushnet Holdings trades at a price of about $50.50, has a market cap of about $3.4 billion and a dividend yield of about 1.6%, whereas Callaway trades at about $19.70, has a $3.6 billion market cap, and they actually suspended their dividend in 2020. Now, looking at the balance sheet, Acushnet has way less debt, with net debt of about $772 million, whereas Callaway has net debt of about $3.68 billion, which is quite a large balance there. And Acushnet also has a lower net debt to EBITDA multiple of about 2.2 times. So the balance sheet definitely is won by the Acushnet here. Now, looking at the most recent results, Q1 of 2023, revenue was up about 13% year over year for Acushnet, whereas for Callaway, it was up about 12% to $1.17 billion, and EPS outpaced for Acushnet compared to Callaway. But realistically, what we want to look for here is guidance. So the fiscal year 2023 guidance, Acushnet's guiding towards revenue to be up about 6% year over year and adjusted EBITDA to be up about 5% year over year, whereas Callaway is projecting about 11% growth in revenue, EPS is going to be slightly down, or down, I guess, about 20%, not just slightly down. And adjusted EBITDA is looking to grow about 13% year over year. And as you can see from the valuations, especially on the price to earnings valuation, Callaway is trading at more of a premium than Acushnet. So all in all, I don't know if I would say that either company is very attractive. Fundamentally, Callaway is projecting better growth, but is significantly more levered than Acushnet and trades at relatively pricey multiples, while Acushnet has posted better profitability, is projecting lower growth, is less levered, and actually has a nice dividend yield and has grown that dividend over time. Qualitatively, though, Callaway is the more intriguing name to me, as it has better growth levers, such as Topgolf, which is gaining a lot of attraction, and the company is diversifying into sporting wear as well. But at this point, given the mature nature of the golfing industry and Acushnet's better fundamentals, I would probably go with Acushnet if I had to pick one of these businesses. But realistically, I don't think that either really offer growth at a reasonable price.
Good. Yeah, I'd agree. And that net debt to EBITDA multiple of 5.5 times, that's a hefty multiple.
Yeah.
That indicates a levered balance sheet.
Seems like they levered up to buy Topgolf. Right?
Exactly. And that's what it was. So they levered up to buy Topgolf.
And we'd have to look at what type of debt that is. You know, is it a variable rate, fixed rate, and, you know, how long it's amortized over. But, you know, it's a high net debt to EBITDA multiple right now. That has to come down. Or else, you know, especially in a rising rate environment, it is a bit concerning. But there's not enough growth here to really be interested in either company right now, to be honest. Even adding Topgolf, which apparently was growing at a decent clip, at least, it hasn't moved the needle enough to where you want to pay 12 times EV to EBITDA in a highly leveraged company, or 30 times PE, right? It's difficult to pay that when you've got just low double digits, like 13% maybe growth in that range. EPS is actually down. We'd have to look at cash flow growth and everything like that as well. But I don't think either way, it's not enough growth to really be interested in either of these companies.
Agreed. Yep.
All right. Well, let's finish off the show with a star and dog of the week. Brett, you have both of those. I believe we're going to start with our dog, right? That's Tenet Financial. And then our star of the week, we'll end that off on the positive note with Adobe. I think that's the way we're going, correct?
Yeah, that is the way we're going. We always like to end on a positive note.
Yes,
so, we do. Even though star and dog just sounds so much better.
Yeah, it does. That's true.
All right.
Dog and star.
Dog and star. Not the same. Yeah. Not the same ring. Yeah. All right. But our dog of the week, like Ryan said, is Tenet Fintech Group, symbol PKK on the Canadian Security Exchange. Tenet is a fintech technology service provider and operator of Cubular Business Hub, which gives small to medium-sized businesses access to financing, advertising, networking, and business intelligence tools. The company operates in both Canada and China. The stock has fallen roughly 66% to only 13 cents over the past month, leaving the company at a market cap of about 13 million. This recent downfall was the continuation of the share price just collapsing since its high in September of 2021 of $13.60. So effectively, the stock has fallen over 99% since that, making even some of the worst cryptocurrencies blush. So what has caused the utter collapse in share price? Looking at the past year, the company saw a massive decrease in revenue from $34.7 million in Q1 2022 to $29.5 million in Q1 2023, effectively quartering the revenue. As well, the net loss didn't get any better. The net loss actually increased to $8.7 million from a loss of only $3.4 million. And that's not exactly what you want to see in a growing company. Barring one quarter in 2021, the company has been continuously GAAP unprofitable. So all the valuation is effectively coming from the expected growth. So to even see a slowing growth for a company that is valued like this, it'd be worrisome. But to see the utter evisceration of the company's revenue is just eviscerating as well the investors' financial hope. But that's not even the end of the bad news. At the end of April, the board removed the now former CEO, Johnson Joseph, who has been accused of market manipulation of Tenet's share price from April 2020 to November 2021, which, if you recall the dates, that was during the time of their all-time high. The removal of Mr. Joseph has caused a proxy battle now ensuing between the board of the company and Mr. Joseph. But that's not even the end of the bad news. The company is now short on cash to even meet the most basic of working capital, their payroll. So it's now raising money through a private placement for up to $3 million through that placement. So overall, collapsing stock price, disintegrating revenue, squabbling management team, and no cash to even run the company, which solidifies Tenet as our dog of the week.
For sure. Do we want to talk about it
now? Do we comment on this before you get into your star?
If you want to add anything to that.
Well,
I'm just amazed that they can do a private placement.
Yeah, I mean, that's just the most interesting thing about this company right now is that her name is a palindrome, to be honest. Like, to me, I don't... Well, I can't believe this share price went to $12 in that range. We got many questions on them on the way and advised against the business because of where they were doing business. The business was not profitable. There was high growth, not profitable. And now, you've seen it fall off a cliff. It's not very surprising to us. It's maybe shocking to see, the 99% decline, but, you need to actually make money as a business to actually hold a share price. And in this case, really, there's no money being made here. And now tons of losses, and those losses are accelerating. And it looks like other issues outside of just the numbers that you see on the page here. So, it's just a case of people get greedy and see growth that they think is going to extrapolate out into the future, continue to extrapolate out, and not recognizing the underlying risk in the business. And they're definitely here, kind of punching us in the face. And this is why you need quality cash flowing businesses that are growing, not these type of operations, to be honest.
Who here thinks that Brett's going to receive a ton of angry comments?
Oh, probably. Or has it gone down so much that everybody will just say, I hate it?
No, yes, no. Right. This looks like the type of company
I was actually reading through some.
Brett doesn't understand the technology.
No, I was reading through some of the bull boards on it, and shareholders are even more conflicted, I think, than even some of the board members. They're going back and forth on each other. It's just a bunch of piranhas going after each other at this point.
Yeah, I mean, but we'll go back. Look at our previous videos on the company, right? Look at our previous videos on the company. We're warning against being invested based on the valuations of this company. And now avoiding poor investment decisions like this is one of the best ways to make money, keeping your money over the long term and putting it in good companies. So avoiding basically wiping out all your capital in a company like this is something you need to do in your portfolio. All right, let's move to our star in a far better company, obviously in Adobe.
All right, like Ryan said, our star of the week this week is Adobe, symbol ADBE on the NASDAQ. Adobe is one of the largest and most diversified software companies in the world. The company offers a line of products and services used by creative professionals for photo editing, video editing, graphic design, game design, and much, much more. Adobe has risen over 40% in just the last month to roughly $475 a share and a market cap of $218 billion. The sharp rise in price occurring over the last month can be attributed to AI. But unlike many other companies which have effectively just rebranded their terms of big data, machine learning, and of those sorts to AI, and they're not really changing their operations, Adobe, on the other hand, has actually been implementing generative AI, which has caught the attention of the market. Adobe recently released its Photoshop generative AI beta last month and had previously released Adobe Firefly as well. And it is implementing generative AI across its other platforms. For example, we can take this picture here of Ryan, a normal picture of him of every day, and then we can run it through the Adobe beta and maybe want to make him a bit more casual, add him a jean jacket. Or, maybe we want to...
that jacket.
That is exactly his jacket. That's not even the Photoshop. And this is just what took me about 30 seconds to do, for the record. And then maybe we want to show him on his latest vacation. So here he is whitewater rafting in about a 5-minute Photoshop. All the pictures besides the initial one you saw there is completely AI generated. And there you can see Ryan losing his paddle, unfortunately. But the point is, really, these are genuinely useful tools for creators derived from AI, and it already exists. So it's no surprise, really, when the market has run up the stock price so much over the last month. And before that, it was more or less flat year to date. So it's not part of that top 7, top 10 group of the market, which we've seen. they have just risen over the past month by 40% as these tools have come out. And we've looked at Adobe in the past before, and one of our biggest concerns is that their market share being retained. So as other cheaper or free alternatives come from like Photoshop in this case, they need to keep their moat. In this case, AI is their moat at the time being, and they need to keep on adding these sorts of tools because the free versions or the cheap alternatives, they can't keep up with this sort of stuff. But Adobe does release its Q2 results later this week, so we'll really see, is the AI hype really materializing financially, or is it just hype at this point? And we'll see that later this week, which I'm personally looking forward to it. And I think Ryan is as well in that picture.
Of course, you can see I'm really excited.
Can we see some of the Photoshops that you spent 2 or 3 hours on, Brett?
Yes. These ones were, it's actually great how quick it does it too. It's maybe a 10-second load and it loads right in, gives you a few options. I enjoy it just as a...
So on this image with the shark, if people aren't watching this, there's a shark. I'm in a river raft, my hands in the air. I've lost my paddle, and there's it looks like some kind, it could be a great white. I'm not sure behind me coming at.
Yeah, those whitewater river sharks.
I know.
Pretty dangerous. I
love the river sharks. I've wrestled several of them. I'm clearly at this moment going to start wrestling with the shark and take them out. But what do you say to the generative program to produce this? Like, what would you be instructing it to do?
For this one, this is through their Photoshop, not the Firefly, for the record. And this is about 6 different generations. So first I started with the raft, and I just highlight effectively where I want the raft to be. It would generate that, and then I can do another layer, which let's say that's the water in the background, and then I do the shark, I do the paddle, and anything else like that. And you can add, like, I've seen this many places where it's like, you want to remove a car from a background. So actually generate and fill. They had a previous, and like it still exists in the current Photoshop, it's like automated fill or something. I forget the exact term of it, which it would fill, but it's not as clean as this, even though this does obviously have some hiccups in it. But this, like I said, was done in 5 or 10 minutes, this Photoshop.
Yeah, I mean, that's the key, right? It took 5-10 minutes, right? To do
and you can obviously clean it up too, still with their existing tools. And that's the big thing.
Yeah. It's cool. Very cool. And I look like I'm enjoying myself.
Yeah, I'm surprised you didn't pick me as a victim. Yeah.
Nah. For once, it had to be someone else. You're next. Yeah, it's true. All right. Well, I think that's going to close off our week. Again, clients, if you're looking in your account, look for that new report, the U.S. Under 2 billion market cap report. 2 new recommendations in there just came out. 5 or 6 companies we're monitoring, potentially getting into those companies at opportune points over the next year. If you're listening to the podcast, rate and review us on iTunes. If you're watching this on YouTube, smash that subscribe button. Keep the questions coming in. Again, I say we're getting more and more every week. It's great to see. Keep those questions coming in, and we'll answer them every week. As always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.